Okay, well, thanks everybody for being here. This is Harry Boxer from the Technical Trader, one of the first trading rooms on the internet back from 2001. I've been doing this a lot of years, more than 40. I've been doing a technical analysis since then, and wrote a book in 2015 called Profitable Day and Swing Trading. And basically, it expounds my philosophies about technical trading, mostly using 1-minute charts for day trading. But today we're going to talk about a few things, and I'd like to start off with the psychology of trading and what my thoughts are about that. I believe that preparation, focus, and discipline are the keys to success in trading, but part of preparation is being ready. And what I mean by that is psychology. If you don't trade with a clear head, if you're not focused, you don't have a focused mind, you really shouldn't trade that day. If you have personal problems, something going on in your life, whatever it is, you don't have to trade every day. People have this thing about like the addiction that trading is almost like, I have to be in it to win it. That is not the case. Some of the best traders on Wall Street either don't trade or they trade only when they see an opportunity. Cash is king, and it's okay to sit with cash and watch the market and wait for opportunities to come to you. Don't force anything in trading. That's how people lose money. It's almost invariable. Basically, if you have lots on your mind, don't trade. If you're not clear, and as Allah said prior, meditating is not bad. I'm not a meditator myself, but it's something that can focus your mind when you're not clear. The other part that I wanted to talk about this is that I have a favorite philosophy. It's trade what you see, not what you think. The problem with human psychology is you'll think a certain way and you'll act a certain way. You won't let the market tell you what to do. You won't let a stock chart or pattern tell you what to do. You have to be disciplined, focused, and prepared. Those are the three things we'll talk about today. My number one favorite thing, as I said, is trade what you see, not what you think. Your desk and your desktop is really important. The way my desktop is set up every day, if something's off, I literally will stop trading until I fix it, because you have to be in a mindset that's clear enough for you to be successful. The setup on your desk should make you comfortable. I find that I only use 3 monitors. Some people use 8 or 10. I think there's too much information, is overload too. So I like to keep my main screen on my laptop, and the other 2 screens are for informational purposes, for other information that I use during the course of the session. I think one of the things that people have always telling me is, how do I stay in a trade? And the problem with staying in a trade when it's going in your way is that you see a profit, you want to take it, and you end up lamenting that I should have stayed in it longer. How do I stay in the trade? Well, we can talk about that a little later, and I will get to it, about how to manage a trade. I think that's the most important part. Is it's easy to pick a stock, but to manage that trade and make it the most successful you can, and make the most money you can out of a trade, it's a combination of several factors. Let's talk about my philosophy. The early bird gets the worm, and what I mean by that is, folks, I'm a veteran of Wall Street, and I'm on in my age, but I have the energy of a youthful guy. Most people tell me that, but yet I get up at 3:40 every morning in Los Angeles. That's where I live, and I'm on my site by 10 of, and I'm looking at dozens of different sources for information on stocks that may be moving in a pre-market. Now, there's various different websites where you can go to. I use something called stockmarketwatch.com, where you can see all the pre-market stocks that are running, the percent gains, the volume, and it's most important to create a focus list. Now, what I do for my subscribers every day is I spend an hour and a half going through dozens of charts and dozens of reasons. I look for reasons why these stocks are moving, why they're up, and the only time I pay attention to fundamentals, the only time during the trading session, because I am a day trader and a swing trader. But for the most part, day traders are all about technicals. It's not about fundamentals, except for what created the thrust that created that day trade. Meaning, you may have a major biotech FDA approval, or a large contract, or any reason that a stock would have a major deal. I remember one stock called LAZR. It was a great day trade. They came out with a 10-year, $10 billion contract with Mercedes. And, that kind of thing could trigger a massive move, which it did that day. And we're interested in something that pops and sets up a pattern that is indicative to me of something that's going to continue that trend during the day. So what I look for is stocks that are up at least, I would call it, in terms of volume, 5 to 10 times normal average volume over the last 100 days. Now, I use TC2000, telechart, and it tells you point blank that they have something called volume buzz. Volume buzz is the most unique indicator I've ever seen, because it tells you at any time in a session, even pre-market, what that stock is trading as an average of over the last 100 days. So if you have a stock that's averaging 10 or 15,000 shares, and all of a sudden there's 150,000 share trading, and it's 10 times normal volume, that should be something that you want to put on your focus list. And then you go to your chart and take a look at the patterns, and you can glean whether or not, or analyze whether or not you feel that's something that is has a strong possibility of being a day trade. And it's based on several factors. How do I prepare a focus list in the pre-market? That's the way I look at pre-market poppers. I also want to see stocks not only that are trading heavy volume, but also price percentage movement, because price without volume and volume without price, that's two things I've always told my subscribers and my traders. If you have volume without price or price without volume, it's not tradable that day necessarily. Now, volume without price is maybe indicative of something that's going to be a move that's coming up. There may be a big accumulation going on. Price without volume is just too thin. I don't allow stuff in my room that is too thin, or stocks under $2 for the most part. I don't care. There's a reason why a stock is under $1 or $2. It's usually because the company itself doesn't have revenue, or is in a pre biotech phase, or phase 1, or something like that. So what we're looking for is stocks that are on the move with heavy volume, much more of a percentage of volume than normal, and with a big percent gain. Even if it's a 10 or 15 or 20% gain pre-market, that doesn't bother me. We've seen plenty of stocks come up in the morning, up 30 and 40 and 50%, even 100%. And by the end of the day, they're up 200 or 300%. It's a question of momentum and patterns. What criteria should be used to identify the highest probability candidates? Well, the highest probability candidates for me are stocks with what I would call market sponsorship. You can take these low-priced Chinese and biotech stocks and make some money on them, but they're extremely volatile and risky. And I've seen so many pre-market stocks that fly, and by the time the market opens, it'll pop, suck the public in, all the professionals will be selling it, and it goes down all day after that. So that's something that I would try to avoid, unless we're in the pre-market and we're just day trading or scalping it. So I'm going to tell you today which patterns, setups, and technical indicators can best narrow down your trading list. I look for continuation patterns. I look for flags, pennants, coils, anything that's a setup after an initial pop that is not too much of a pullback and also comes on low volume. It's something I call the low volume ebb. I'll show you examples of it when we get into some of my charts. And usually when I do these kind of webinars, I will show you examples from today, from my focus list I created today, so you can see something that's actual current, and you can also see the ones that worked and the ones that didn't work, and how do you protect yourself as well. Once the day gets started, you have to maintain your focus as the trading unfolds. And how do you do that? I think the best part of the way to do that, first of all, in my site, I do that for you. Every 20, 30 minutes, I'm back on the air and I'm showing you patterns as they're developing. I'm giving you an expose of how these patterns are developing and what signals they may be giving for future price movement, because they are considered continuation patterns. So the best early price and volume patterns that I use to focus my lists, I will show you in a moment. And you also have to ask yourself, how many positions are too many? I basically believe in the following. How many day trades you need in one day to be successful? One. But that doesn't mean you can't trade 2 or 3. But I would not go more than that, and I certainly wouldn't do 2 or 3 at a time, because that's where you get distracted and lose focus. The best way to maintain focus and to have the highest probability of profiting is to pick out one stock and follow it religiously, closely, scale in and scale out. What I mean by that is when human psychology is to make a decision and go with it. Like if you wanted to trade 5,000 shares of a stock, why buy it all at once? Why not buy 2,000 and then add to it as if the stock moves up? What do? I average up, never average down. Why average down on a stock that's going against you? Probably that most people will, that's where they lose money. They buy a stock, they think it's good. Oh, it's pulled back, it's even cheaper now, I'll buy some more. And it gets cheaper, and I'll buy some more. And they end up in a massive loss because the stock never comes back or has ended up being stopped out. And that's another thing. You cannot trade in this trading world without stops. If you do, all it takes is, now here's what I tell my traders at all times. All it takes is one big loss to wipe out your capital. You can't afford that. And never trade it in stocks during the day, especially on a day trade, without a stop. If you don't know where the stops are, you can always ask me. When you're in my room, I give stops and targets on everything. When I issue a day trade, I give you what the targets and stops are at all times. And I monitor them during the course of the session. So you're not on your own during the trading. I'm there with you. And you always have the ability to ask anyone in my room and ask me. For example, David, can you see this?
Yeah, I see your site.
Okay, good. I just want to make sure because last time that wasn't available. This is my website. It's called The Tech Trader, and that's me. And when you log in, you go to you go into the trading room, and you'll see all kinds of people talking about different stocks. Right now, you're seeing after hours, where I post a lot of information about stocks that are popping after hours, and it's why it's moving up or why it's moving down based on their earnings report usually, or unless there's some other news. In the morning, I come in and I post a focus list. It's a very active site with a lot of very active and traders, and some of them have been with me for more than 20 years, believe it or not. So it's a place where I think people have success. They like each other, and I don't permit egos or negativeness or any bad feelings in a room. I cut to the chase quickly and eliminate that, because my philosophy has always been that when a wheel is bent, when the spokes in a wheel are bent, the wheel wobbles. And we don't wobble in my room. It's a successful room. So to go back to where we were, how many positions are too many? I believe, number one, never have more than a quarter of your portfolio, maximum 20% to 35% in any one position. It's dangerous because if it goes against you, you wipe out your trading capital. So it's okay to have 2 or 3 different positions. But I always also maintain that you should keep 20 to 25% at all times in cash for something that may come up when you don't know it. And then you shouldn't have to sell something to buy something else. So for example, in a $100,000 portfolio, I maintain that 20 to 25,000 in each would be max, up to 3 positions max. That's the way I tutor my traders. I don't believe that you should overtrade, and I don't believe you should overposition. And I also believe, as I said, in scaling in it to a position and scaling out of a position. You don't have to buy it all at once. You don't have to sell it all at once. And you can, and what I also do nonstop during the trading session is I tell people where to raise their stops to, where the new targets are, and so I guide you all session long. So and by the way, my site always has a 2-week free trial. So come to TechTrader.com. One second. You go to the TechTrader.com, and you can sign up for a free trial. By moving right to their start a free trial. Put your information in, no credit card necessary, and you're part of the 10-day free trial, where most people tell me to make enough money in 2 weeks of trading for free to pay for a full year subscription. By the way, the other thing is, if you're a newbie and you have very light experience, my strong recommendation is to come into my room, listen to what I say, pick out a stock or two. First of all, you need to find out psychologically what kind of stock are you comfortable with. Is it something that's a low price stock that you can trade a lot of shares? Or is it something that is a little bit more stable that you feel more comfortable with, like a higher price stock? Now, we trade them all in my room. But I'd also recommend that in the first week or two, or even during the entire trial period, that you paper trade. See how successful you might or might not have been If you're a newbie, if you're a accomplished trader, no problem. So in addition to maintaining your focus as the session unfolds, you need to know what the best patterns are and what kind of trends and what kind of volume patterns are going to work for you. You have to pay close attention to trend changes during the trading session. You'll find that I come in and I draw my trend lines, but I change them all because stocks don't move at the same rate at all times. They may thrust early on and then level out or move in a shallower angle, and that's fine as long as the angle is up. I prefer 45-degree angles. I find most stocks that are real trenders will pop up and trend up at a 45-degree angle from the lower left-hand corner to the upper right-hand corner of your screen. That's a 45-degree type angle. Now, also during the day, when you're trading, you have to determine possible intraday divergences, including entry and exit signals, where a stock may go against you quickly, or the divergence will give you a clue because the underlying technicals are not confirming the trend. There's so many that people can use, but I keep it simple and only use 3 or 4. Some of them are proprietary from TC 2000. I'll show you that in a moment. Now, the discipline part about trading is probably one of the most important things. Trade management is very, very important because it basically maximizes your potential for profit. And as I said before, one of the things about trading is that people make the decision to buy and make a decision to sell, and they buy it all or they sell it all. And I find that most successful traders position themselves. They will add to a position. They will buy 1,000. They will add another 1,000 if it breaks out. If it goes above the target and keeps running on volume, they'll add it. You can add on it going up, not add on the way down. One of my most successful trades ever made was when I kept adding to a position over a period of weeks. Now, this was not a day trade, but I bought a stock at 17 and went to 27. I bought more, went to 37. I bought more. There's no reason, if it hasn't broken support, just keep buying more. Well, finally, the stock got up to 120, and I exited most of my position. And that took 6 weeks because the stock just kept moving in a rising channel and never broke support. That's one of the keys. Look, every stock's going to go up and pull back, go up and pull back. It's going to stair step higher. Don't get spooked by every little pullback in a stock. Well, that's one of the things that most people tell me, that they'll watch a stock go up, 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 and as soon as it has a down bar, they'll kick it out. And they'll kick it all out. Why not scale out? Why not put stops at certain levels where you can, for example, if you got stopped out of one portion of your position, say a third or a quarter, you still have 2/3 or 3/4 of your position left if the stock goes back up again. If it goes down and takes out the second stop, you should probably be out of it. But the prudent use of targets and stops during the trading session is paramount. Okay, you have to use stops, and you have to use know where your targets are. Now, as I said, every trade in my room, I give you where the targets are and where the stops are. The only thing I don't do is tell you the exact price at which you should enter. I tell you when a stock breaks out, I give you a buy alert, and you can use your judgment as to where the stock might be. For example, if it pulls back a little bit and holds support and starts to move again, you can buy some. If it breaks out above the morning high, you can add to it. And we'll show you some examples. But basically, that's my philosophy on trading. And I wanted to talk to you today about, number one, the psychology of it, which we did. And then the 3 things that I deem most important in trading, particularly day trading, is preparation by being there early in the morning. I kind of want to review this because it's very important. You'd be there early in the morning with me. I'm online. You should be there too. You'd be surprised, dozens and dozens of traders online with me every morning. Those are the guys that make the most money, because we spot stuff like this morning and yesterday. We spotted a stock that was up 200% pre-market even before the market opened. And I tell them most of the time, when that happens, be aware of the fact that it could pop at the opening and then die the rest of the day. We see so many of those. So that, but there's a lot of opportunities where you can trade early. And I have a couple of traders that point blank tell me, I want to trade before I go to work. I have to leave at 8:20. And I tell them, fine. If you're on the West Coast, you can trade from, pre-market from when my first webinar that I give you guys in the morning is about 10 after 5 every day in LA time, 10 after 8 Eastern. I'm on for at least an hour to an hour and a half before the market opens, giving you constant updates on the pre-market picks. Or going over my focus list. Now, the focus list may consist of anywhere between 10, 15 to 20 stocks. But in terms of the buy alerts, it's usually 6 to 8 early on and maybe a couple of 3 after that. So you may have 10 or 12 during the course of the session. But I also try to furnish lower price stocks, medium price stocks, and higher price stocks for different traders in my room who like different kinds of stocks. So there's a lot of information in my room. If you're a newbie, I strongly suggest trade on paper, do paper trades. See, right up here, you can click on TC2000 and create a paper account and trade. So let's go over some stuff today from just this morning on stocks based on my philosophy, how we traded them and what they did. Now, in the pre-market, after hours yesterday, GSUN popped and pulled back and formed what I call a bull coil or bull wedge. In this case, because of the wide up width of it, it's a bull wedge. Now, as soon as the market opened, the best way to do this is to go back in time. I want to show you this. This is what we saw when we came in the morning, right there. That wedge. And I said, if it pops, it'll be something to go. Look at that pop. And then the volume came into it there. Just before it came in, right there, is where we went long. Pop, sell half, because that's where I had a target. This literally went from 3.5 to 478 in 3-4 minutes. Now, of course, that doesn't happen every day. How about $7 10 minutes later? So if you sold half, and by the way, you see this line here? So as soon as I see a stock back off and start to move, I put a line right there. What is that? That's support. This 404, 403. That level was a support level. This was a bull wedge. Note that when at the apex or end of this pattern, the volume got very low. I call that the low volume ebb. Invariably, in the mornings, when I see stocks pop and do this and have a low volume ebb, and then it pops, you buy it right there. So anyone who didn't buy it in my room got a buy signal at 4.5 and went to 7 minutes later. Now, I think I told everybody to sell it right there at about 660. You know, I'm never going to top take everything, but that's a pretty dang good trade. Now, if you were disciplined and you wanted to stay in that stock, what would you have done? In my room, I tell everybody, last pullback low, put a line underneath it. What is this stock forming here? I'll tell you what I thought. Another bull wedge, which basically, when stocks move in 5 waves, Elliott wave, this is a 1, 2, 3, 4, 5. But a lot of people count from this opening. That's a 1, 2, 3. When this formed, it looked like a wave 4 bull wedge. And I said, yeah, this could pop if it gets above 690.95 above there, then it could go to like $7 or $8. But it didn't. It broke down underneath the pullback low, which at that point was 584. 584 broke, retested it, couldn't get through, and the rest of the day, here's what happened. So what was the point of being in that stock the rest of the day? Nothing. So the bottom line is you got in here and there, you got out either when you sold it at spike or when it was stopped out. Another example, MTC this morning in the pre-market just exploded. Now, I did spot this here. This was a little wedgie, a mini bull wedge, but it was very quiet volume. So when it really spiked up and then came back down, I said, if this breaks out, which it did right there, it was a buy signal. Within a minute, it exploded about 60 cents. It was halted and then exploded. Now check this out. This is literally a 3-minute trade from about 285.3 to 439. And I told everybody to exit the stock, not because not because of anything other than it went to a 1, 2, 3. It was at the wave 3 top. I also told them you can sell 50 to 80% of your position here, your choice, and then put a stop under that line. And you can see within minutes, it was stopped out. So if you sold 50 to 80% of your position anywhere there, and were stopped out of the rest, you averaged somewhere around 420, and you got in around 310. Nice trade. And again, the rest of the day did nothing. Look familiar? almost the same as that. BVS. Now here's one that didn't work great, but it was profitable. It's exploded so fast. I said, we're going to wait on this one. And this was a little bit of a falling wedge. One of my favorite patterns. It popped out right there was the buy signal at about 460. Within a few minutes, it was 504. Right there, you could have got a 44 cent scalp trade. But it settled down, and then it popped again. It got up as high as 520. Unfortunately, the rest of the day, it kept doing this. So at some point, you'd have to make a decision. Do I want to hold this or not? Do I want to scale it out? Whatever. Or you had 1, 2, 3 chances to sell it in the 530 range. And you bought it down here at 470. So it's not, you're not getting filthy rich, but you made 60 cents on a $4 stock. That's 15%. What is this pattern? It's called an ascending bull coil. An ascending bull coil is very bullish. And when stock closes like that, look for that the next day to make another move. So this is something I would watch carefully for tomorrow. DSGN. The way my system works is I'm looking for a gap or a pop, and I'm looking for a wedge. I'm looking for a flag or coil, falling wedge, whatever it is. I'd like to see it break out. Right there was the buy signal at about 395. And with about 45 minutes, it was up to 455. 60 cents. What did it do then? What did I do then? By the way, all along I was raising my stop to there. Why? That's the pullback low. Raised it to there, and then raised it to there. At no point did it break that. So you don't have to sell when a stock reaches the target, but I strongly recommend if a stock does this kind of a move from 380 to 455 that quickly, you always exit a portion of your position, whether it be a quarter to a half or whatever. And then put a stop underneath the pullback low, in which case the stop here was about 444 or a little less than that. And never actually put it at that point. It's always a few cents below. So 440. Then the stock ran to 475 and gave you ample room on a 1, 2, 3, 4, 5-wave move. Now, the volume wasn't heavy, and it didn't make the top of the channel. But when it started to roll over and broke the channel angle, that's usually where I exit right there. SMT, again, example, this is from today. I'm not cherry picking. These are stocks from my focus list. Popped. I remember seeing this wedge. You see the wedge there, folks? When that stock pops and wedges and breaks out, we want to see volume. So volume started to pick up. That's where we put a day trade on it. It went from 460 to 535. A 70-cent trade on a $4 stock, always a good thing. Notice this little flag continuation pattern. This little mini wedge, also a continuation pattern. This flag or coil, a mini flag, a mini wedge. It just kept doing the same kind of bullish patterns. No reason to sell it. Not until it takes out this support, that support, that support, that support. Keep raising your stops. This is how you stay in the trades. Raise your stops. And usually you'll hear me say, when we get a runner, one that's going crazy, a stock that'll go from 10 to 25 or 4 to 15 or something crazy like that, it's got momentum, but I'm putting stops in all the way up. And I'm also recommending when to sell something. When I see a spike up on volume, for example, in this case here, it took a spike up, and I believe I said sell it at 5 or better. Now pull back down, and you could have sold, half here and half there, or a quarter and a quarter, and still have half. Here's the bottom line. That's where the stop was in place. Notice these highs and these lows in here. It never broke a stop point all day. This is one of my favorite trades today, and I like this company. It's called Jemaya. It's supposedly the Amazon of South Africa. But after popping early, there's where I put a day trade on it, around 605. It spiked to 645, 40 cents very quickly, and then came down. But notice that this line was not broken. That's where I put support. Thank God it didn't break there, because look what we would have missed. It exploded there, at which point I said, sell some of your position at around 6.5. Came down and wedged. formed that kind of a rising pattern and never broke until here. Now, I actually had a $7 target. The high was exactly 7 to the penny. I'm not sure anybody got out there, but you can see that if you didn't, and it looked pretty good here. I want to show you this. It's kind of interesting to always go back on a trade and examine it. Folks, I also want to recommend to diverge for a minute, that everybody that trades, that's listening to me today, have a trading log. Always keep a log of every trade you made. Do it when you make the trade. Put in, I bought 3,000 of JMIA because of the early pop and flag. I put a stop in here. I put a stop in there. If you examine what you did during the day, you can learn from your own successes and mistakes. And I think that's the way to be a better trader. So here, notice that our support here, support there, support there, support there. Finally, that support broke at about 660. But if you got in early on when it was 602, you still made 60 cents or 10% on your stock. These are 1 minute intraday charts and using Telechart 2000 or TC 2000. And here's the thing called, after hours, it's called post buzz. This basically means that OLB, for example, see this after hours volume, is trading 84% above the average volume for after hours for the stock. Now, tomorrow, this could be interesting. You always go to the daily chart, look at that. Look where overhead resistance is. This is what I do, by the way, every day on every stock, including the day trades. I want to see where overhead resistance is. I always draw my lines pre-market so you can see them. And you can see here, this resistance was taken out and pulled back. So what we're going to look for is this gets above 560 tomorrow, it could explode again. And based on the after hours action, now forming what looks like a wedge, this will be a candidate for my focus test for tomorrow morning. EVER, pop, wedge forms, spike down though. So when I see that breakdown, I wait. It broke out from the flag. It broke out again. When it broke out here at 23.75, that's where the trade pick would be. Then there is a bull little wedgie. This is a mini 1, 2, 3, 4, 5. So therefore, I wasn't surprised to see it pull back down. Notice it held support right there. The stop is below that. It held that white dotted line as the volume weighted average price. You'd be shocked how many traders use the volume weighted average price as key support. Notice it held it. Ran up, formed a large, call it a coil. Broke out, retested it. Notice this never broke support here, 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 or there. Even at the end of the day, it was still doing some stuff. Now, this is after hours, but towards the end of the day, this stock never broke support. So if you're in at 23.5 and you're out at 25.5, not a bad day trade. Trupanion. Now, this is one that exploded, pulled back, and then popped. And I want to show you that the breakout occurred right there, and it retested. A lot of times the stock will break out and retest that point, and when it goes, that's where the buy is. And for me, the buy was actually closer to 23.40. But look what it did after. Pop, wedge, pop, coil. And it's amazing to me. Most people don't realize that when stock breaks a prior high, it becomes support. Successful test, successful test. When you see that developing after a high is broken, it normally means they're going to take it higher. And sure enough, I moved from 24.39 to 25.50. So you added to this position, but you're in at around 23, and you got 2.5 points on it. And again, the rest of the day, keep raising your stop, keep raising your stop, keep raising your stop. It never broke support. Now, you might have had to stop there. Yeah, that's what I would have done. So you would have gotten stopped out there. So what? Stopped out at 25 and you're in at 23. Not a bad trade. So in the morning, folks, just to reiterate what I was talking about before. When you come in the morning, and by the way, look at the prior day. Really important. If a stock explodes the prior day and does this, many times, like I said on the other stock we talked about a few minutes ago, many times when a stock is setting up like this, this is called a bull coil. And when it explodes that sharply and doesn't go anywhere all day, It might be a setup for the next day. Look how important this was, breaking out right there at 22.19. So I waited for it to pop and pull back and make sure the momentum was there. Let's go back on it and you can see what I'm talking about. The best way, an example, is to take a look at where it was when we came in. Right. So it popped right from the get-go. This is before I even came in. I'm not there when the market opens. The market opens, I think, at LA time at 3 or something like that. So it's already open 45 minutes to an hour by the time I get there. Pull back, pop. Now pull back, and I said to you earlier, hold right there at support. That's why I was interested. This had momentum. I felt it could go. Popped again and formed a coil or wedge. Didn't look like it was done to me, although it did have what I would call pre-market 1, 2, 3, 4, 5. Nevertheless, momentum was strong, and then it formed yet another flag. So if you're in the stock, you just let it ride. Too many people get nervous. They see a little down bar, they sell. You sell when the stock breaks support, not when you see a down bar. Don't get nervous. Stocks will come down no matter what. Nothing goes up straight, except for maybe this stock. 1, 2, 3, 4, 5. You see how it pulled back here, pull back here, pull back here? Did it again? You're going to get those pullbacks. You have to take a deep breath and watch the stock back off. And look at the breakout. It kept going. Beautiful chart. And then it even kept going further. But it did pull back here. That probably would have broken your stop if you had a tight stop. I always tell people to tighten their stops. The higher up a stock goes, the more you want to preserve the profit. So even if you get stopped out, you can always, I always do this too. I always give you 2 stops. So you stopped out there, your second stop would be there. Stopped out there, but it didn't stop out there, and you're still in half your position or thereabout, and you're still making money. And you're still in the trade. And that's how you stay in the trade, by keep raising your stops and exiting in tranches or in pieces. Again, you have to be able to analyze. See, I wrote a book called Profitable Day in Swing Trading. And a lot of it had to do with pattern recognition. I really believe that recognizing the patterns as they form, recognizing the volume that comes with those patterns. Notice that every time a stock popped here, it thrusted on volume, it pulled back lightly, it thrusted on volume, it pulled back lightly. It happens most of the time with stocks that are running. Here's one that just went vertical and didn't really work except for one thing. I want to show you something. Pre-market, this is what we saw. When we first saw it break out, it did this. Very sensitive. Okay. I saw this. That would be a very tight bull wedge. See it? And as soon as it popped, it was actually a buy 260. Well, let's look where it went after that. And where was the stop? Right there. So you had a 20-cent risk. 242 or so was the stop. After this, here's what it did. 287, 288, 296. Look, I mean, and if you're in here at 253 and you saw 296, 45 cents in like 7 or 8 minutes, would you have taken the trade? The answer is, if you don't take the trade, or at least 80% of it off the table, then I don't have any sympathy for you when the stock goes against you. You can always, if you want to play with house money, that's what I tell them. See what happens? Look at this. So if you didn't get sell the spike anywhere in there, you were stopped out as soon as it broke below 272. Eventually got down to 250 some odd, bounced. And look what it did the rest of the day. Now in the afternoon, I told my people that look what's forming here. Left shoulder, head, right shoulder, with a kind of a down-sloping neckline. Right there. So I gave a heads up that it might be a buy if it breaks out. It broke out, it formed a bull flag. I thought it was going to really make a move, but it never followed through and pulled back. Drifted into the close. Nevertheless, net on the day, 46 million shares, up about 13% on a low price stock. Why would you not keep your eye on that for tomorrow in case it pops in pre-market and starts to run again? And like so, here's a perfect example. The patterns I look for every morning. And this is not even pre-market. Because pre-market, it was meh. But this is what I saw later in the day. That doesn't mean you have to trade early on or even pre-market. If you're sitting on your hands and you're looking for a trade, you see this spike followed by that wedge. This is what you would have seen at the time. Bull wedge. So we're waiting to see if it pops a 1660, 5560 with energy. It's got to take that out right there. But you already saw what this did. It immediately popped and broke out, settled back and made an higher high. Pull back again, formed a, what is this called? I noted that today too. This is a bull coil. Pop wedge, pop coil. 1, 2, 3, 4. It's going to have a fifth wave, likely. 3 out of 4 times. Boom. Now, my target was 17 and then 17 3/4, I think, but it hit 17 there. So if you were in at 16.5, there's a half a point scalp trade. Then it pulled back to test the channel and it popped again. This time it went up to 17. My target was 17.25. It hit 17.20. So ample. By the way, I highly recommend when I give you a target, never go for that last nickel, that last penny. If I say 17, sell it at 16.97, something like that. Never, and round numbers, believe me, folks, everybody's watching round numbers. You want to be out before they are. In any case, you have a stock that's trending all day. As a broken support, if you put your stop there, raise it to there, raise it to there, and raise it to there, you're never stopped out. The stock is still trending, and it's only 3 o'clock. Boom! How about that? 1781. Now, I always tell everybody, after multiple waves up and then a spike up, I would exit the stock every time. You're going to get, it's invited. This is too far too fast. After multiple waves, it usually invites profit taking. Now, normally, what I want to see is high volume there. That didn't occur here. It's a thinly traded stock. And you can see the rest of the day, it flagged. Now, this is another one I'd look for tomorrow. Let's look at the daily chart and check this out. This is beautiful. You have a long-term decline followed by a breakaway gap here, a triple top breakaway gap there. This is a breakaway that's a running gap. It pulled back down. Where did it test? The prior highs, which is support, and bounced. What's it doing now? One, two, three, four. 4 times it couldn't get through 17.5. It did it today, and it closed there. Definitely have to put this on your watch list for tomorrow because it could be 19 or 20 tomorrow. Especially with a closing bull flag. When the stock does that, very bullish setup. SEMR. Now here's one that took a hard dip at the opening. This is a V bottom or right-hand extension, is what I call it. So when you're looking at this stock, first thing you do, if you're going to buy, is put a stop right there. You want to see, ideally, it take out resistance. I'm going to say resistance is in a zone. So the actual exit entry point would be right about there at 13.20.25. It then popped and had a little mini falling wedge. It popped and had a beautiful bull flag and just kept going. Mini flag, wedge. But what did it not do? That's right. Support there, support there, support there, even there, and there, and there. Still hasn't broken. You're in at 1320, and by 2 o'clock, it's 1480 with 2.5 points, 20% trade, and you have a choice to make. I want to be a piglet or just raise my stops. You could just raise your stops. At the end of the day, you sold at 1460. So you waited, lost 20 cents, but it was worth the wait because that setup could have blown to 15. And that's another one based on the pattern and long-term chart. Check it out. A massive base is being broken out. That's EMR. Could run. Could get to 17, 18 in the next few days. Fabrinet. It spiked, it formed a flag, and it broke out. And then it came right down to it. Held that zone, spiked up again. This was not a very profitable trade because most of us got in and when it broke out about, I think it was at 204. It did immediately spike to 218. Now, I'm not saying you couldn't have made money 204 to 218, but you had to be quick and nimble because that thing literally went 1, 2, 3, 4 minutes. 4 minutes. 204 to 218. Then it pulled back down and consolidated and coiled. It looked to me like a coil was going to develop into a breakout. And when that coil there broke out there and flagged, I thought, boy, this is going to make a move, but it did not. So it's called a head fake. The volume wasn't there. That's one of the things, the keys, folks, when you're looking at trading, make sure the volume is with you. If it isn't, it could be just a few buyers doing market orders, and next thing you know, the stock breaks down on you. It's a great looking chart. Look at this pop. Here's a couple. First thing you want to do, look at this daily chart. Unbelievable. Now, this is a reverse split stock that did not trade at 258. But when I see a long base being broken out, this was a buy back in January, excuse me, at $8.80. And today it hit 63. That took 5 months. Look at this breakout. This stock never broke its support here, there, or there. Got right to it, didn't break it. Also held its red dotted line as a 50-day moving average. For those of you who are interested, I use 10, 21, and 50-day moving averages. The 50 is where institutional traders trade. Excuse me, when I see a stock come off of a key support, price, moving average, and trend line, all the juxtaposition of these three right there. And notice this is where the buy was when it popped out. It went across here. Now for today, when I looked at the chart, and it was breaking into a new all-time high. When it did this, formed the flag. Now the flag took an immediate hit and then broke out. So the trade was right there at 56.5 3/4. In minutes went to 63.50. So there was 6-7 points in it very quickly, in and out. And you see the rest of the day. If you don't take the trade, this is what could happen. So why not take the trade? What I would have done is sold half the 3/4, and then I would have put a stop right there. See these 3 bars? If a stock holds a certain level, that's support. That's where you would have gotten stopped. You sold a bunch here, and you got stopped out the rest there. That's okay, because you're out of 59.5, 60, and you paid 56 for it. You did well. What I'm showing you is my methods of day trading and the stocks, the patterns I use. But all of this is predicated, just to reiterate, be in there early, watch my focus list, watch the criteria I use and how I set up the early part of the session too. You know, they say that the professional traders don't even trade pre-market. They only trade after they see how trends are developing. And that's true. If you see how a trend develops early on, you can make a lot of money very quickly. Dave was a perfect example. But knowing that Dave's a thin stock, although a good company, a thin stock, I knew that this could pop and drop. Well, it certainly exploded, didn't it? Here's another similar example. Band, I came in the morning and band, why is this line here? People always ask, what are those lines? Well, I'm always drawing support and resistance in. If you go back, you will see various different lines of support and resistance bands. You come in the morning and it breaks the band, and it does it with a gap, and then forms a wedge. As soon as that wedge breaks out, it's a buy right there at 22. About 25. 3 points. I don't think it took 15, 20 minutes. What would you have done then? You raise your stop to right there, and you got stopped out there. Not so bad considering where it went the rest of the day. Staying in a stock that and hoping it comes back is the dumbest thing you can do. The 3 things that Wall Street, no matter what Gordon Gekko tells you, greed is not good. Fear, hope, and greed are the 3 major negatives for your mind that will cause you to lose money. It's another perfect example, same thing. GFS popped from the wedge and broke out. That's where it was a day trade. 51.5, 55.5, 4 points. And I mean quickly. Some of the trades in my room develop fast. A lot of guys trade quickly. They're in, they're out, and they're gone for the day. I have professional golfers in my room who come in and do that. They put some trades on, they put their stops and targets in, and they go to practice range. And then after the 5th or 6th hole of the round they're playing, they'll look at their cell phones and see how much money they made. And I said to them, that takes all the fun out of trading. You know what they said to me? Yeah, but it takes all the emotion out, and that's true. Human emotions is principally why people lose money. Here's one that just got away from you. It exploded, pulled back, and just kept going. Now, the place to have bought it in my mind was right there. Once I look at the double top above 16.5, it went vertical to 1735.40. Nice trade and a quick one, too. And an OX. By the way, I really like the stock. Take a look at the setup here. This one is an Israeli X-ray imaging company. They have a new technology. They got FDA approval. X-rays without the X-rays, meaning without radiation. So this one went from 526 back in February to 1428 after FDA approval. Note what it's done since then: an orderly retraced falling channel with multiple waves down, and now it's got this coil forming. So today, it popped early from the wedge, and there's a trade right there, but it couldn't get through key resistance, which is 990 to 10 zip. So watch this stock going forward, because a breakout above there could spike this into 11, 12, 13, 14 range or more. CGEM, look at this swing. This is one of my swing trades that I put out. And boy, we were lucky because I put it out when it broke out and pulled back, but then it came down. Where did I stop it? I said, if it gets below 1490, we're out. What was the low? 1520. So I never got down to that level. Okay. But look what it did since then. In about a week and a half, $15.29 to $30. It doubled in a week and a half. And it's got a bull flag on the daily chart. So I'll always look at the intraday chart and see what we can come up with. Well, there's also a falling wedge here. Keep this in mind for tomorrow. And then there's one of my favorite long-term swings that I put on for the tech traders back here. Impinj is a great company. 1, 2, 3, 4, 5 waves down. Basic Elliott wave stuff. Breakaway gap, most importantly, above the moving averages, which were curling up and crossing over. If I can leave you with one thing, folks, I'm going to leave you with one thing. On the daily chart, when the stock breaks the downtrend and does it with a gap, it doesn't have to be a gap, but if it spikes up through the moving averages and then pulls back for a few days, moving averages have a chance to cross over and hold those moving averages. It's the best time to buy a stock for the intermediate to long term. In this case, when it did that, I put a swing on in the high 50s. It's 6 months later, and the stock reached 168 today. Phenomenal day for that stock as well. It was even a day trade when it popped on the opening from the wedge, broke out right there at 163 to 167, and after hours 168. So anyway, I hope you guys learned something from how to day trade and the types of patterns that work best in day trades. More importantly, the psychological part about trading what you see, not what you think. If you start to think about how great a company is or what the product line is or any of the other fundamental, what I call BS, because technical trading tells you what a stock is doing and tells you what internal, it always reflects it. Now, of course, when a stock breaks down or breaks up on news, you can't always tell that. And technically, the stock may not have told you that, or it may have. But I want to leave you today that you need to trade with a clear mind, be prepared, come focused, come with confidence, Make sure your desk is set up properly. And always trade what you see, not what you think. And also trade what I tell you to trade. And listen to what I tell you in terms of support, resistance, and targets. And stay on with me every day. When I say time for an update, jump on with me and listen to what I say, because I'm showing you the charts. I'm showing you the patterns as they unfold. I'm telling you where this may be breaking down, or this may be breaking out, or you need to raise your stop, or you need to exit half your position, or whatever. Anyway, that's the guidance I give you every day. And you have the ability to private message me with any questions you have, or anyone in the room. You can talk to each other. It's one of those trading rooms. So folks, I hope you guys gleaned a lot from that. But more importantly, I welcome everybody to come into the room and come to my page and log in without a credit card. Stay for 2 weeks. What do you got to lose? Nothing. And you may end up making a lot of money. At the very least, if you're a newbie, paper trade. If you're not, take some of my advices and see how much money you might make. People that come into the trading room often stay, and they often stay a long time when they stay. That is it for today. That's my presentation. I hope you guys enjoyed it, learned something. I certainly did, and appreciate you all. Look forward to seeing some of you in the trading room. And that's it for me today.